Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at another vol capture trade and slightly bearish, believe it or not, on SanDisk SNDK, a long-term sell strangle that literally has no downside exposure simply because taking advantage of the huge implied volatility and longer-term options sets up ideally for these long-term sell strangle trades. We've been doing a bunch of these lately now that the VIX has become elevated, starting to soften. And if it does soften and if the stock basically pulls back just a little, you can get the best of both worlds. So let's jump in and take a look. As we always like to do, we use that fusion approach using fundamental, technical, and most importantly, implied volatility analysis to find the edge and put on the hedge. So as far as a fundamental perspective, we can see SanDisk, the price to sales ratio, basically since it got spun out of Western Digital, now still over 10 times price to sales, the highest by far we have seen after that monster rally to start this year, right? Starting to slow down, so I cannot imagine a further multiple expansion from here. In fact, you'd probably look for a somewhat of a multiple compression going forward here. So certainly SanDisk at extremes from a valuation of fundamental perspective. From a technical perspective, the stock starting to slow down as well. That 700 level seems to be some overhead resistance, to say the least here, right? Has been up there several times and then pulled back. So we'll see if that continues or not. But as we said, rip-roaring rally to start the year. The stock closed last year at roughly about 250 bucks, give or take. So we are up about $450 or so on the year, right? And that's only over the past couple months here. So certainly a red hot rally in SanDisk as it followed the AI mania, right? But starting to get a little bit of pushback. We like that doji formation here with the stock making new all-time highs, but then having a little hesitation. Still has not gotten past that level, so we kind of like that as well. Technical starting to weaken after getting to extremes, right? So we had 9-day RSI almost at 90, right? We had MACD at the highest level by far over the past year. Bollinger percent B over 1, right? But all these starting to weaken a little bit. We like that as well to set up ideally. IV has not weakened all that much, which we want to take advantage of here. And speaking of IV, we can see that the implied volatility, and I pulled off 120-day IV for the longer term kind of options, still hovering at the highest level we've seen over the past year, right? Just off the highs. You can see from yesterday to today that IV on the long end jumped as well. We can see IV generally back over that $100 level. So IV certainly not cheap here. It reflects maybe not percentage-wise, but price-wise in the long-term options in a nice way. We'll take a look at our trade in a second. Current IV percentile still very rich at over 70%. So that sets up ideally for a sell strangle trade going out the longest term options, right? December of 2028. That doesn't mean we're going to hold them that long. Previous trades that we've done certainly several of these lately with IV at rich and stocks at the extremes, right? To take advantage of that combination where you basically can eliminate any downside on the stock, right? And have a huge cushion to the upside going long term. We close one out basically in one day. So certainly the fact you're using super long-term options doesn't mean you're going to be holding those for that period at all. In fact, we're just looking for either the stock to pull back a little, right, because we'll end up being net short delta-wise, believe it or not, or more importantly, IV to just come in a little. We'll take a look at that in a second. So you can see selling the December of 2028, right, with over 1,000 days to go, but selling that strangle, selling the 600 put and the 1030 call, the extreme on the call side, the highest listed call, right, and getting over $600 net credit on the trade. So by selling the 600 put and getting over $600 net credit, you literally have no downside exposure. If SanDisk goes bankrupt, you still can make some money. we'll take a look at in a second at how much upside you do have. Note too that the delta on the call, even though the call is basically over, 500 almost points out of the money, right? 400 points out of the money here, right? It's a 70 delta. Why? Because the IV is over 90 on these long-term options on the call side. You can see the put trading at a similar IV over 95, right? The delta on that put, right, of 19. So certainly selling the call, selling the put sets up to be net bearish, if you will, even though the put is only 38 points out of the money, right? It has a much lower delta than the call, which is over 400 points out of the money. Why? Because of that IV, that huge upward drift kind of skews the delta. So that sets up ideally for that sell strangle trade, right? Selling the 1030 call, the $600 put, bringing in over $600. So your downside, right, is negative, right? There is no downside. The upside break even is 632.65, right? By selling that 1030 call and bringing in that 602.65, your upside break even is over 1600 or almost $1,100 upside cushion from here, right? Well over 170%. So you have plenty of upside cushion on a stock that's already up basically almost 200% this year. You have another almost 200% to go. At some point, you would think that it will slow down, right? Trees don't grow to the sky forever. The IV, current IV, as we said, on the sell strangle, selling the call and the sell and put, right around 93. And the delta, believe it or not, you'd be 51 deltas net short, even though, as we've talked about, the put is just barely out of the money. The call is huge amounts out of the money. That's the advantage of selling these IVs. So from a theoretical perspective, right, I pulled off the current kind of, theoreticals and what happens if we just have a slight drop in IV. So I'm using that 92.81 on IV here. And let's say it drops to 88, not a massive drop at all, still very elevated, right? But you can see that the theoretical value of the call goes from 305.81, where it is currently, to 287.76, or about an 18-point drop, right, on the call just by that small drop in IV. You can see the call delta actually with the stock. We're keeping the stock and everything else exactly the same, just moving IV. The call delta actually drops about 2 points simply by having the IV drop, right? IV, has that effect, and upward drift, right? So with a lower IV, right, you expect the stock theoretically to move up less, right, which makes the call delta lower, right? On the put side, doing the same thing here, moving that IV from the current level to 88, we can see moves that put value from 286.60, to 272.69, or a very nice drop of almost 14 points. So if we just get IV to drop from where it is now, over 90 to the upper 80s, we'd expect about a 30-point gain on the trade, right? Or about $3,000 for each straddle or strangle that we sell here. So certainly provides some nice benefits here. A way to sell inflated IV, and that IV, as we said, still at extreme levels here, right? So we're just looking for a pullback towards this level here. We're not looking for it to go back anywhere near these levels. If it does, even better, right? Basically just moving back to where it was, moving back to that dropping. Here's the shorter term, but that would certainly take that into play very nicely. So as far as the fills, here's an actual fill I got on the trade, right? I put it out there at 602 limit. I actually got filled at 605. There's going to be a little bit of back and forth on this, so certainly don't go market. Put it out there at a marketable limit, right? And you can see able to get in on the trade. But most importantly, you can see the buying power effect only ties up about $9,000 on the trade, right? And if we're looking to make about $3,000, you have a very nice about 30% or so, even a little bit more, return on the margin required to do one. So that's a way to take advantage to sell inflated and volatility, take a somewhat bearish viewpoint on SanDisk, which has been absolutely ripping to the upside here, right? So if you do have IV drop and SanDisk drop, you get the best of both worlds. But if you just have that IV drop, right, you have a very nice potential profit on the trade with the stock staying stagnant. The other thing is you have the ability, in case, say, SanDisk does rip to the upside, right, you can move that 600 put higher, maybe to the 700 put, right, at some time, pick up even more premium, give yourself more upside cushion. So that's how we go about identifying trade opportunities, take advantage of high levels of implied volatility and extremes of stock, which are both finally starting to show a little weakness. We don't mind taking these positions, but we're not going to jump in front of the train until it slows down here. So we'll keep you updated on how this one fares. So until next time, as always, here's the good trading. Take care.